Hello, millionaires. Welcome back to the millions. One of the biggest mistakes I see people make is not preparing for inflation. They spend years building up their savings, only to see it eroded away by rising prices. That's why today, I'm sharing 10 inflation-resistant assets that can help you protect and even grow your wealth in 2025 and beyond. Let's dive in. First up, we've got real estate. Real estate is one of the best hedges against inflation. As inflation rises, so do property values and rental income. Landlords can raise rents, keeping pace with inflation and even exceeding it. Plus, real estate is a tangible asset. Unlike some investments that can disappear overnight, real estate provides a sense of security. You could look into REITs, or real estate investment trusts, which allow you to invest in real estate without actually owning physical properties. It's a great way to diversify your portfolio and tap into the power of real estate. Next up, we're talking about gold and other precious metals like silver and platinum. For centuries, gold has been seen as a safe haven asset, a way to preserve wealth during times of economic turmoil. Its value isn't directly tied to currencies that can be printed endlessly. When governments print more money, it can lead to inflation, devaluing your cash. But gold has a limited supply, which means its purchasing power tends to hold strong. Having a small portion of your portfolio allocated to precious metals can act as a form of insurance against inflation and economic uncertainty. Let's talk about commodities. These are the raw materials that make up the foundation of our global economy. We're talking about oil, natural gas, wheat, corn, copper, and all those essential goods that people rely on every day. As inflation rises, the prices of these raw materials tend to increase as well. Demand for these commodities remains relatively stable, even during economic downturns. One way to invest in commodities is through ETFs, or exchange-traded funds, that track the performance of specific commodity indexes. This allows you to gain exposure to a basket of commodities without having to directly buy and store physical goods. Inflation-linked bonds. Built-in inflation protection. Let's talk about a more conservative approach to inflation protection. Inflation-linked bonds, or TIPS, which stands for Treasury Inflation Protected Securities. These bonds are specifically designed to protect your investments from inflation. The principal value of TIPS adjusts with inflation. So, as inflation rises, the value of your bond increases as well. This means you're getting a return on your investment that keeps pace with the rising cost of goods and services. TIPS are considered a very low-risk investment, especially compared to stocks or real estate. If you're looking for a way to protect your capital from inflation, and you're not comfortable with taking on a lot of risk, TIPS are definitely worth considering. Stocks in essential industries, profiting from necessity. Think about the companies that provide the goods and services we absolutely can't live without. Utilities like electricity and water, healthcare providers, food and beverage companies, and consumer staples. These industries tend to be more resilient during periods of inflation because people still need their products and services, regardless of the economic climate. Companies in essential industries often have the ability to pass on rising costs to consumers. Investing in a diversified portfolio of stocks in these sectors can provide a hedge against inflation and potentially generate long-term growth. Dividend-paying stocks. A steady stream of income. Dividends are essentially a share of a company's profits that are paid out to shareholders on a regular basis, usually quarterly. What makes dividend stocks particularly attractive during inflationary periods is that many companies have a history of increasing their dividends over time. As inflation rises, these dividend payments can help offset the rising cost of living and provide a steady stream of income. When choosing dividend stocks, it's important to focus on companies with a strong track record of profitability and dividend growth. Look for well-established businesses that have a history of weathering economic storms and continuing to reward their shareholders. Please like and subscribe to our channel for more insightful content on inflation-resistant assets and investment strategies. Cryptocurrency, a speculative hedge. Bitcoin, Ethereum, and the thousands of other cryptocurrencies out there have gained a lot of attention in recent years. They offer a decentralized, digital alternative to traditional currencies. Crypto is still a highly volatile asset class, and its long-term viability as an inflation hedge is still debated. However, some investors believe that cryptocurrencies, particularly Bitcoin, could offer protection against inflation due to their limited supply. Bitcoin has a fixed supply cap, which means its value is determined by supply and demand dynamics in the market. If you're considering adding crypto to your portfolio, it's crucial to do your research, understand the risks involved, and only invest what you can afford to lose. It's a high-risk, high-reward asset class that should only make up a small portion of a well-diversified portfolio. Let's move on to a more unconventional asset class, art and collectibles. We're talking about rare paintings, classic cars, vintage watches, rare coins, stamps, and other unique items that people are willing to pay a premium for. Art and collectibles might not be the first thing that comes to mind when you think about inflation protection, but they can actually be quite effective. Art and collectibles are tangible assets with intrinsic value. They're not subject to the same inflationary pressures as fiat currencies or even some financial instruments. During periods of high inflation, people often flock to tangible assets like art and collectibles as a way to preserve their wealth. This increased demand can drive up prices, making them a potentially profitable investment. Investing in art and collectibles requires specialized knowledge, an understanding of the market, and the ability to authenticate and properly store your investments. Now let's talk about private equity. Private equity involves investing directly in privately held companies or assets, rather than publicly traded stocks. These investments are typically less liquid than public stocks, meaning it can be more difficult to sell your investment quickly. However, they also offer the potential for higher returns. During periods of inflation, private equity can be an attractive option because these companies often have more flexibility to adapt to rising costs. Private equity investments are not directly correlated to the stock market, which means they can provide diversification benefits to your portfolio. If you're considering private equity, it's important to remember that these investments are typically only available to accredited investors who meet certain income and net worth requirements. Finally, let's talk about infrastructure investments. Infrastructure refers to the essential physical systems and facilities that support a modern economy. We're talking about roads, bridges, airports, seaports, power grids, telecommunications networks, water systems, and renewable energy projects. Investing in infrastructure is a way to bet on the long-term growth and development of the economy. As populations grow and economies expand, the demand for new and improved infrastructure increases, driving up the value of these assets. Infrastructure projects often involve long-term contracts and concessions, which can provide a steady stream of cash flow that is often indexed to inflation. You can invest in infrastructure through specialized ETFs or mutual funds that focus on this sector. So there you have it, 10 inflation-resistant assets that can help you protect and grow your wealth in 2025 and beyond. Remember, diversification is key. Spread your investments across different asset classes to reduce your overall risk. What are your thoughts? Which of these assets are you most interested in? Let me know in the comments below. And don't forget to like, subscribe, and hit the notification bell so you never miss an upload. Thanks for watching, and until next time, happy investing.